So I'm Simon Martin. I'm Senior Partner and Head of Research at Tristan Capital Partners. Tristan is an investment management firm, manages capital, primarily investing in opportunistic and value-added deals right the way across Europe. Manage about €8.5 billion worth of real estate for about 85 different global, institutional, high net worth and public and private pension plan investors.
Great, Michael.
Okay, Michael, Neal. I'm Head of UK Investment. I also chair, though, our Real Estate Debt Investment Committee and our Investment Committee for Equity, and that's for all the way across Europe. In terms of TH Real Estate, you're probably all familiar, but we're a large business owned by Teachers Insurance, Annuities Association in the US, very diverse client base, around about sort of 23 billion of assets under management across Europe, and primarily I would say investing into the core and core plus space.
Great.
Hi, I'm Mark Rajbenbach, partner at Taylor Wessing. Paul's already sort of introduced the firm generally. I'm a London-based partner, focusing across the real estate sector, but also with sort of quite a lot of experience in European transactions and hotels.
Great, James.
Hello, James Raynor. So I'm responsible for Grosvenor's European activity. We have about, I guess, €3 billion of assets that we own and manage, primarily in France, Spain, and Sweden.
Super, Josh.
Josh Short, Internos. So we have about €3.5 billion of assets in 11 European countries. We have offices in 8. We have about 20 vehicles, which is probably too many. We do some unusual things though, like we manage a UK listed REIT called Local Shopping REIT. We also have a hotel fund capability, and we also do quite a bit of retail property in Germany.
Great. Michael.
Good morning, Michael Walton, Chief Executive of Rynda Property Investors. We're a Northern Western European investment management business. Our clients range from 2 sovereign wealth funds. The more recent focus has been a co-investing asset manager with various forms of global capital.
In terms of Will's presentation there, quite strong on the GDP growth, and you could see that also getting higher as you moved east. What's your sense, particularly looking at the markets that you're looking at, and the UK in comparison to continental Europe? How do you see those macro pictures playing out, and is that influencing where you're looking to place your money or clients' money?
Yeah, certainly it is influencing where we're looking to place money. I think everyone's been generally pretty surprised on the upside in terms of GDP growth. If I single out the Netherlands, I don't think people would have expected the type of interest that the Netherlands has generated over the last year, and what the prospects are for the next few years going forward. So those things are very important. We're looking to try and find places where we think income is particularly cheap. And I was very interested from Will's presentation, quite what a large percentage, you're looking at Benelux countries where we are particularly focused, and with a little bit of luck that'll be where our next deal closes before Christmas. We also, as a house, think that we're not pessimistic on Brexit, and actually we think the UK income is better value than just about anywhere else in North and Western Europe at the moment.
Josh, maybe just picking up with you, because you're active across Europe, do you want to just briefly cover some of the activity there's been in the press and the corporate activity for Internos? Just give us an insight into that and maybe why that happened, and then we'll pick up some of the other themes. But I think people would be interested in the room in terms of what led to that deal.
Okay, so it was announced last Friday that Internos had sold itself 100% to principal global investors of the US. Not many people, interestingly, in Europe have heard of Principal. They are a top 10 American real estate manager with about $75 billion of real estate assets in public and private equity and public and private debt. They do have an office here in Wood Street in the city. It does global REITs, but they don't do any indirect real estate funds in Europe. They do equities, bonds, commodities. They're about a $650 billion global manager. The reason I think they bought Internos is that They've got clients in the US who are giving money in Europe to people like Blackstone and Brookfield and Lone Star and Starwood, and they are unable to service them. They are more of a core manager than they are an opportunistic manager, however. And what we had, which they wanted, was flags on the ground, 100 people, 8 offices. Curiously, for an independent private firm, we're regulated in Germany, Luxembourg and France, which for Brexit purposes and their own planning is interesting. So I think they, we carry on to work for them. We stay independent in terms of our management. They have, they will probably bring people over here next year, and they'll have oversight rights in terms of what they do, and they will put people on our board. But I think strategically for us and for them, it's a very good situation.
Good. And then feel free to ask questions later should you wish.
And I think in terms of investing, I mean, we're really investing, crudely, what we have capital for. So that's 5 things. Hotels. So we had a core hotel fund run by Jochen Schäfer and ex-Invesco. Some in the room know him. He's been very successful with that first hotel fund. It's sort of because of its timing, basically. It was buying in 12, 11, 13. It's done opportunistic returns in a 40% core levered fund. And his second fund will be more value add. So, that'll probably be a theme you'll hear from the panel. He's going to take more risk, shorter leases, more refurbishment and even redevelopment opportunities in hotels. He's bought 1 in the second fund. He's about to buy 2 more. He'll have about £500 million of capacity in that. Secondly, offices. So we're buying core European offices for German institutional clients because Internos bought the Commerzbank business 4 years ago. So we've got about 400 million of deals in Italy, France, Germany and the Netherlands in investment committee right now. Thirdly, we buy retail property in Germany, edge of town, out of town retail for French clients. Fourthly, we have a UK shared ownership vehicle. We run for a huge county council pension fund, 300 million. That's been slower to deploy than we'd like, but it is beginning to deploy. And then fifthly, I can't remember what 5th is. James.
Come back to it.
It's not that important, is it? I think we should just stay on this subject for a bit because it's interesting. I actually think it is interesting because it tells you a lot about, I think, what's happening and what priorities of capital are. Because I think that you're seeing, you have to ask the question, and I say this not facetiously, why is somebody buying into Joss's business? And a key driver outside of Joss will be there is a desire to get capital effectively into markets that people are unfamiliar with. So the cross-border capital is happening, but I think there's a realization that it's actually pretty difficult. It's not that easy to just go and place capital. And I think this is not the first time that essentially a very large principal player has bought into really a platform, an operational platform, possibly for some financial metrics, but really as a way of getting money and pursuing their own investment goals. And so I think that notwithstanding where we might be in an economic situation, which I'm probably more bearish than maybe the figures would suggest, and maybe some of my other panelists, I think there is nonetheless a weight of capital that has been created because of huge volumes of QE and so on and so forth that needs to find a place. It is propping up the market artificially a bit at the moment, but nonetheless it is a factor. And people are looking for ways to deal with it, and it's not going to go away. So I think you need to be, if you don't have that requirement to invest, then I think I would sort of say be cautious and be very selective.
Okay,
which
good.
obviously they have been in choosing you.
Very sensible people. Mark, Josh, you can pick it up if you want. Yeah.
Well, just very quickly, I think that's very well said. I mean, I think those in the room, we can't. I mean, I sit on the board of Great Portland Estates. I have done for 10 years, And there is, at the moment, this amazing disconnect between the share price of Great Portland Estates relative to NAV and where we can sell buildings. And we've been selling buildings ahead of book value, so which is CBRE on a quarterly basis. So it's sort of, and when we keep anticipating and expecting a correction, and I think that's true for a lot of long income, well-covenanted properties all around Europe, but it's just not happened. So QE is a big factor of that. And then I think the other thing we're seeing is infrastructure. There's just so much money everywhere hunting for yield, and we're beginning to see sort of infrastructure funds sort of coming into our space. So the world has definitely changed. There's still that weight of capital. That's still the desire for income. Something will correct and change. And a lot of intelligent people have been saying it should have happened already, and it hasn't happened. So it is a rather unusual situation.
Yeah, Mark, I just wanted to pick up with you because there's obviously been, this year there's been a lot of corporate transactions. You've obviously had Blackstone, Logicor, you've also had P3, various others. I mean, in here slightly different, but you've just had Hammerson and M2, that's a different one. If you look at that, do you think that's, it picks up a point Will made, that people are going to be buying platforms, partly because maybe it's more difficult, it's easier to put the money to work that way, rather than going and buying individual assets, and that's a different way to access the market. Do you think we'll see more of that?
Yes, I think we will do, and we are, as you mentioned, the Hammerson trade already, and I think we're seeing it across the sector, so on a very sort of large scale to access different countries, different expertise, and diversify in a sort of quick way, or a quicker way than buying up assets individually, or also placing expertise and developing your own platform. I also think we see it on a sector basis, so people acquiring, say, as Joss mentioned, either like a hotel platform of itself. There's lots of trades in the market there, rather than individual sales, even though arguably sometimes on a breakup basis you get a better valuation. So I do think it's likely to be a trend that will continue and we'll see more of, and I think we are already seeing it.
Okay, good. I just want to pick up a couple of UK ones, which you may also know. Is there, and this is for anybody also, but we had the recent changes in UK capital gain tax. Will that impact pricing? Is that going to make a difference? I'm going to pick up the UK property sectors one shortly when we look at the sectors. But are there things like that you think are going to impact pricing? Anybody? I think on that particular, I think regulation or the increased regulatory environment is a concern. I'll be interested to hear from others. I think one thing it may do, in particular, the latest UK announcement on CGT, may actually drive people more into listed vehicles and listed real estate, conversely. But I'd be interested to hear from others on that. Certainly that would be a way of sort of alleviating the sort of capital gain issue announced in last year's budget. But I'd be interested to hear others' views.
Yeah. I sort of have the view at the moment, which is I'm not sure what can possibly happen that really will impact pricing. I'm not saying that the pricing shouldn't be impacted, but we worried about capital gains. We had Brexit last year, and that should have destroyed prices, and it hasn't. So I sort of think that there's a certain things just keep going along, which is not a good position, but I think that that's what's happening.
Okay, good. Michael, you wanted to just pick that up, and then I'm going to come to other Michael. So once you've finished, Michael, start shuttling that. Nobody will notice, and it'll all look perfect.
Yeah, I take the view that this capital gain seeing is important, and it very definitively should have an impact on pricing. The models that we've run pre and post budget, and those impacts, and obviously those impacts are still a couple of years out before they start coming in, but they do have a material difference on IRRs, and they should make a 5-7% difference to the price that people are paying. So I think it's the sentiment that is being shown by central government in terms of additional taxation. But I do share James's view. It's extremely difficult to see what actually is going to knock this very fast-running train off its rails.
Okay, good. Michael, I just wanted to pick up also with you, UK in comparison to continental Europe, because you're obviously sitting on the investment board for Europe, but also focused on the UK. Are there particular sectors, picking up one of the points here, that you think will outperform in terms of your house view?
Okay, so I mean, you know, in terms of the TH view, really, I suppose you would have seen some of that in the presentation that Will gave in terms of the overall drivers. In terms of the sectors in UK comparing to the rest of continental Europe, you know, you have a different relative base upon which you're comparing returns. Clearly, our German clients in particular, insurance clients, they are looking for income. They are risk off, broadly speaking. They are not looking for strong, high IRRs. Clearly, they'll take them if that's the end outcome. But they are buying into strong income, 15 years ideally, and they're paying the price that is the market price for that type of vehicle, and obviously for that type of stock clearly, and you know, cost of debt as well is certainly leveraging decent cash-on-cash returns even at lower yields. In terms of the UK's, you know, the sectors that our clients are starting to look at clearly are alternatives. And from a house point of view, that's an area clearly that we are looking to sort of try and move into. Interesting, actually, our debt teams who have been active in the market have been sort of doing a lot of underwriting on the alternative space, student accommodation and the like, and that's providing again very good returns for those investors. And I think Will picked out in the UK actually that from a liquidity perspective, there's around about a third of all transactions at the moment taking place in that alternative space. It's a shifting picture at the moment. Retail is, you know, a subject I'm sure we'll talk about in a bit more detail. You know, we're all aware of the sort of structural headwinds that retail's facing, but clearly there is a place for shops, and there's a place for the covenants in particular that you know are underpinning a lot of the investment stock in the UK at the moment. It's very varied in terms of its you know, in terms of its outlook, and I'd say in retail in particular that traditional valuation models, you know, can find it quite difficult actually to properly try and underwrite where the net operating income might come from. So again, from our client's perspective, more a core player ourselves. You know, the core assets, the prime assets are where our investors are looking for us to transact. But again, in terms of liquidity, I think you know, I saw for the 9 months, for the first sort of 9 months of this year, around about typical MSCI portfolio might have 40% overall of retail in their portfolio, but liquidity overall is only about 12% of the market. So there is some retail stock out there. Some of it's not shifting, but some of it is shifting, and again, it often comes back down to lease lengths. So really, our clients looking for sort of security of income in particular, broadly speaking, I think risk off, looking for the sort of sectors and the locations where there's structural drivers behind them. Industrials is clearly another area. We saw the returns that Will had mentioned, absolutely stellar. You know, around about sort of, I think the 10 months this year in industrials under MSCI, around about 15%. And you know, there's some momentum that's going to be carried forward into 2018 in that regard.
Okay, good. Simon, I wanted to pick up with you because obviously you're looking at research and strategy. Just pick up a little bit in terms of what the macro is saying to you in terms of whether that's influencing the Tristan investment strategy or not, and also just pick up the point I think from James in a way there, which is, you know, there should be all of these risks, but maybe nobody's taking any notice of them, and maybe even the risks advance of nuclear war and various other things. Actually, the markets will just continue merrily on. I mean, what's your take on how the sector is seeing that?
Well, I mean, it's interesting. I spend a lot of time with our clients talking about, you know, kind of what they see in the world and what they're worried about and what concerns them and how they want to allocate their capital. The one thing I think that, and it speaks a little bit to what James was saying and what Josh was saying as well about the volume of capital, is that when you talk to them, what you find amongst them is that they're generally under-allocated to Europe. And there's some BIS data out there from a very macro level that looks at reserve currency manager allocations to different currencies. And you know, if you look across reserve currency managers, they took reserve currency allocations from near 30% in euros in 2010 all the way down to 19% by the end of last year. So there's a lot of people who've edged away from Europe over the last 4 or 5 years. I think a lot of those people are now starting to say, well, I just can't be that under-allocated to this part of the world, given what's going on in Asia and given all the other risks that are out there. And so I think you've just got this sort of big macro shift of allocation coming back into Europe. The challenge that you then face when you're trying to put that to work is it's a negative yielding treasury market out there. High yield bonds in Europe and across the corporate sector now yield less than US treasuries do. And so it's just very difficult for them to find anywhere to park it. They want to do some stock investing, but they can't do their entire allocation in stocks because most of them have liability matching issues to deal with. And so real estate, infrastructure, all of the private markets and all of the alternative spaces are places they need to explore. And I think when you start to think about the size of Principal Group and all of those other players who are out there who need to allocate capital, you are talking about a lot of flow. We live in a very liquid market. It can't cope with huge volumes. If you funnel between 50 and 100 billion euros through the European real estate markets a year, you are going to support pricing. So I think from a macro standpoint, while you've got that shift in allocations and while you have a negative yielding environment for fixed income, I think there's an underpinning factor there. The question we all have to resolve in our minds is, can we get comfortable with the nominal yield we're required to pay for a building given the underlying macro growth environment? And the only argument I'd make is I think that's got meaningfully easier over the last 2 years because of the GDP growth and the reduction in vacancy rates and the absence of development and the degree to which the leverage side of our capital structure hasn't been gunned. I think we'd all be much more worried if we could see LTVs being pushed aggressively, if we could see an awful lot of credit coming out of the banking system and fueling incremental demand for the asset class, and if we're also seeing huge surges in development in lots of the markets we're all active in. And I think right now those triggers, those flags aren't there. So, from our standpoint, I think, we want to stay invested and we want to invest more capital, and our clients want more capital, but what they're saying to us is, look, we recognise we're in a cycle, or a market that cycles, but keep an eye on those key flags, keep an eye on development, keep an eye on credit, understand how those change the market dynamics, and if you see any signs that they are changing the way in which that growth outlook or that cap rate outlook looks to you over a 2, 3, 4 year time period, then you can do something. But right now, they want to be invested. The biggest problem they have is they can't stay invested. Particularly if you look at the opportunistic guys, they put opportunistic fund money to work, we're recycling it out faster than they can give it to us, frankly. And so it's very hard for them to stay allocated within the context of the way in which the market is working. And that's going to be the real challenge. And you look across a lot of these guys, you look particularly to the big sovereigns, and they have a rapacious appetite for core assets. And they just can't feed that appetite fast enough. So to the platform deal question, why are you seeing so many platform deals? Well, because there's a lot of appetite for owning core. And there's a huge business in manufacturing it. We just can't manufacture it fast enough for them to get it into their portfolios, frankly. So I think while you've got all those structural trends backing up the market, it's very hard to see anything changing to the downside unless we start to build a lot or leverage up what we've got to try and satisfy ourselves to get a higher return level, which we don't see.
Okay, good. So the fundamentals are supporting it now versus 2 years ago, in essence, as well. Michael, just for you, I mean, long-term money, core. What's your sense of the product that you can access now? How difficult is that? And also, let's take from 2 years ago or a year ago. Are you having to change your idea of what core is, or your idea of what returns are, in order to be able to be active in the market?
Well, I think Simon just touched on really in terms of manufacturing core. Certainly for some of our funds with the return requirements that they have, there has been a reluctance actually to sort of reduce those down. So they are looking at the markets and looking to try and see if they can ultimately access that. And it is quite patient capital actually. And if it takes sort of 3-4 years ultimately to do a development, then they'll wait and they'll get the right returns through manufacturing on that basis. So across Europe in those core markets, that's broadly where a lot of our kind of certainly office exposure is starting to move towards realistically.
Okay, good. There's one other thing that's coming as well. I mean, we did in each of the, just because at the time when we were just doing the German one, the Merkel coalition had just sort of disappeared. So we asked a question which was France now the most politically stable country in Europe in comparison to the UK and Germany? And did the same. And interestingly, there is a mini poll running which you can join, and at the moment it's split 50-50 between France and Germany, and the UK has nothing in terms of being strong and stable. But just quite interesting to see how things could change around in a relatively short period of time. Mark, just to pick up with you actually, there's a question here on the listed sector which was mentioned. Do you think there's going to be more consolidation in that area particularly? How do you see that playing out? And also just on the political point that I just raised there was a question that came in which is to say that although there have been changes in Europe, continental Europe, it doesn't seem to have impacted or influenced the real estate sector. But let's say, for example, there was a Jeremy Corbyn government. How would that be seen by others? You don't need to give a Taylor Wessing view on it, but you know, would that create a genuine issue, or is that more of a UK-focused issue?
Yes, I think generally on the political question, markets have responded sort of, they're relatively robust. So I think, you know, there was a concern, obviously, Germany, and there was a sort of potential rise of the far right in other European jurisdictions over the last 12 to 18 months. I think that's largely been allayed, even notwithstanding the fact that in Germany they don't seem to have yet finally formed their coalition. But my understanding from talking to a few people, in fact also in the breakfast, is that that doesn't seem certainly not to have affected the view towards Germany. So I think those sort of events don't seem to have impacted significantly from what I understand. I think what is more concerning are the sort of the other geopolitical risks, i.e. North Korea, Trump, that those sort of more, if you like, certainly more significant than Merkel forming a coalition. But those sort of things create significant unpredictability, and I think arguably, and this isn't a Taylor Wessing view, a Corbyn government, in my view, could have a significant negative effect through not knowing what sort of, if it brings in rent controls, that sort of restrictions on getting capital out of the country, all those sort of things that Labour introduced 1970s, then that I think would have a very significant impact, indeed far beyond the sort of European government's slight rise at the far right, which has largely, I think, been allayed.
Okay, good. James, just picking up with you on that and Brexit a little bit. Obviously, everybody in Paris and in Amsterdam are delighted to have got the banking agency and the medicines agency. Frankfurt was expecting to see quite a lot of new demand based around movements of jobs. Do you see much impact from that, and is that influencing any of your decisions about how you're investing?
No.
Excellent. Would you care to elaborate?
I think, yeah, sure. I think that there will be some places on the continent which will get a boost because there will be more jobs and so on. But I mean, this is not, you know, the scale that's changing things enormously. I think that those jobs that are going to move, they're being spread around. I think if they were all going to go to one place, that might make a difference, you know. But I think that they won't, so they might make things a little bit better. But I don't think that they're fundamentally, you know, they're not shifting GDP numbers, you know. I don't think that that's the case.
Okay. Yep. Go ahead. Yep.
Can I just come on, I was going to say, I totally agree with that when it comes to the sort of UK and the bigger countries. I think where it makes a bigger proportion of differences in the smaller places. So Dublin, to a certain extent, I mean, you know, you spend any time in Luxembourg, they're running out of office space and it's going out of fashion. So it can make a big difference in the smaller places. I'm not sure it makes a big difference in the larger places.
Okay, good. Joss, I just wanted to pick up something with you, which is obviously previously one of the risks that was the rise in interest rates. We've had a little uptick of interest rates here. Do you see that having an influence, or do you think that's going to stay where it is? What's your view on it?
Well, in the UK, you probably might see one and potentially two rises next year. Europe, difficult to call, but I mean, I think it's still fairly flat and benign. I mean, people must look at interest rates because, you know, they're very correlated to cap rates and yields. But again, I think it's one of those things that's out there. Investment committees and risk committees are thinking about them. They're probably putting them in their models when they're underwriting returns on a go-forward basis. But actually, I mean, I actually think there was more uncertainty this time last year than there is now. You know, if we were sitting here this time last year, you know, the whole European election cycle was uncertain. Okay, Merkel aside, but I think personally that will get sorted. Actually, European politics are better. You know, we've got GDP growth in the G20, you know, with the UK at the bottom of that. Surprise, surprise. I think that's the first time the G20 has been correlated like that since 2012. So, you know, the political outlook to me is better than 12 months ago. The economic story is better. Yes, interest rates will start rising as a result. But again, I'm sort of with the guys here. There's not a lot. Okay, Trump, you know, Tel Aviv and Jerusalem. I mean, there's always something to raise anxieties. But actually, you know, it seems okay. Seems okay.
You know, I'd largely echo that, and I'm convinced we are in a far more positive position than we were last year, looking forward for the next 12 months. I would, however, just suggest that look where the debt is sitting in the world compared to where it was 10 years ago. And UK corporations generally very underleveraged. A lot of government debt. Look where the percentage of GDP the UK government debt is compared to 10 years ago. A lot of over-leveraged governments from that point of view. But particularly look at individuals. We've had retailing that perhaps until recently has continued to go forward, but people's earnings have actually gone backwards in inflation terms. So how's that all been financed? Been financed by the most extraordinary amount of personal debt. And when that starts to go wrong, where's that going to impact in terms of house pricing? And if you look at what's been triggers of the last big recessions, it's usually been house pricing and the saving ratio. And both of those are now turning negative.
Yeah. So from your point of view, actually that's a bigger risk to the UK economy with interest rates going up, just the fact that people are over leveraged, especially in the residential sector.
It could be. Interest rates tend not to make a lot of difference with somebody that's got a personal loan because such a small percentage of the 10-15% they're paying. But it's just the type of sentiment of lending and whether the Bank of England is going to start to rein that in. If that starts to try and be collected, a default start, that's when you start to get that type of snowball effect. And I think that's something that I would certainly be looking out for going into the next 12 months.
Okay, good.
And just on the list, I mean, I think the listed thing's very interesting. Actually, I think Hammerson taking out into history sort of dictates that when you have one of these deals, you have a bit of a flurry. And so I would predict that next year, because I used to be an investment banker, so those guys will be running around with books, to Land Securities, British Land, Great Portland. You name it, you can guarantee it. So I think you might see, interestingly, quite a bit of activity in the listed sector in the UK next year.
Just what I was going to say is, if there's one thing that will close the discount to NAV that exists right now, it will be a flurry of activity in the listed sector because, you're absolutely right, Josh. The minute you get one big deal, there are a whole bunch of pitch books flying around. And that will very quickly eradicate the discount that exists right now. So you might see that gap close back up again.
And do you think that's, in a way, needed in the European listed sector? Do you think that sort of consolidation is a useful function, and will we see that also in the unlisted fund sector?
I think the challenge you have in many respects is there aren't enough decent-sized entities relative to what you see in the US for people to invest in. So I think one of the challenges for the European listed market is there aren't enough big cap companies for people to go to try and get the kind of spread that they can achieve in the US. So I think any kind of amalgamation, growth, improvement in that segment in the US is going to be in Europe is going to be very welcome for people. I'm not sure that it necessarily changed that much within the unlisted sector, although I think there are a lot of people who probably own big portfolios who will then start to look at public markets as a more viable exit strategy for what they own. There's been a bit of activity in that space, but there could be more activity from the larger public markets owners as time progresses over 2018 and 2019, and people try and put things out into the market.
Okay, good. Yep, go ahead.
Yeah, I suspect there will be activity. I mean, there'll be activity for one reason, which is it's very difficult if you're trading at a massive discount to NAV to do anything except buy another company that's also trading at a discount to NAV. And there's only so long that companies can sit doing nothing. But I think the advantage of the listed market, and I think maybe we touch on in terms of the private market, is it's reasonably perpetual capital. Yeah. And so I think that we're seeing now a big move into more open-ended kind of structures, which is, always threatened to get going in Europe, but never really has. But I think there's now really getting some traction, and I think that's actually for the longer term quite sensible for the market, because we'll never be right about where the market is, but I'm pretty sure that unless you're an opportunistic buyer, anything that you're buying right now, at some point, it is going to see a valuation downturn. Yeah. So I think you need to be looking at, am I buying it in a way, and is this the kind of asset that when it loses 20% of its value, I'm still going to be feeling okay about owning it, and will it come back? And so I think that if you are in structures where actually over the next 3 to 5 years, that structure is going to constrain that sort of ability, then I think you might have a problem. Because I do think we need to be thinking about that. Okay, this year might be fine, next year might be fine, but at some point it won't be. And what you're owning now, unless you've got a clear view that I'm selling it is going to have some sort of wobble. And so I think you need to be clear about how wobble-proof are my assets. It's not a technical thing.
Yeah, something I've been focusing on for a while.
Yeah, I think the US coming out of the financial crisis, I think their REIT market, they really grew exponentially. They raised capital, they deployed capital, they really went for it. You could argue that in Europe we didn't, and we should be criticised for that, and I'm sort of with that personally. So I think Simon's absolutely right. We should have bigger vehicles in Europe, and clearly Hammerson and Into, if it happens. I mean, will they merge and then Simon picks it off? Who knows? But I mean, you should have bigger vehicles. One, two. I think James's point about the core open-ended funds. Principal, who's buying Internos, they have a $9.5 billion core open-ended US fund. My old shop, Prudential Financial, has something like a 20 billion vehicle. And everybody was predicting 10 years ago that you were going to have these larger core open-ended European vehicles. And that is now sort of happening. CBRE have got a big one, Invesco's got a big one, TH has got one going. And in a way, that's part of the... I mean, that was my number 5 that I completely forgot about. I've just created this morning. No, Townsend gave us money to take a portfolio in May this year to create an Internos, a nice balanced core open-ended European fund. I mean, you can run these things as smaller entities, but actually you tend to find that it is the big guys, I'm afraid, who run these big funds. Tristan aside, of course. That's a trend. I really foresee that because people want core at the moment, low leveraged core with income. I think there will be more and more capital getting allocated now to open-ended European vehicles, and then it'll be up to the manager to deploy sensibly and wisely.
Okay, good. Yeah, Simon, go ahead.
I was just going to come in quickly on it. It's just, I think as well, just to both James and Joss's point, that market is growing really quickly now. So you've got even Blackstone are in that market now. And once you start to see people like Blackstone and KKR and Carlyle putting together vehicles that are going to go and exploit that space, I think it's pretty clear that segment is going to grow very, very rapidly, and it's going to grow to a very significant size. And I think, the point about it, the ability to control the flow of liquidity is incredibly important in that. A closed-ended fund is by definition forced to do something. An open-ended fund isn't, providing they control the way in which their redemption profile works. European funds historically have had no control over their redemption profile. US funds have, and that's the difference. And I think that's what you'll see over the course of the next decade. You've got a bunch of open-ended funds where the manager controls the way in which the redemption process works. And that's a huge market in the US, $230 billion dollars worth of capital. And I think it'll be a big part of the market over here over the next decade or so.
I'm going to shift to a sort of, because of the timing, I'm going to shift to a slightly more quick-fire approach for a minute, which is, Michael, we mentioned retail, so let's go into a little bit more in terms of your view on retail. Obviously, there are lots of concerns from the US, of dead malls, those kinds of things. Situation here in Europe very different, but do you see, I mean, Will mentioned maybe a good outlook currently for retail. How do you see that? You're doing a lot of activity in retail. What's your view?
Well, I mean, you will have heard about some of the themes, and from our perspective, it's experience and it's convenience, which are the sort of two key sort of themes, and value. Convenience comes from the retail parks, and again, if you've got good income, long income, you've got some good robust covenants that are underpinning a lot of the investments, and they do look good value. And I think Will mentioned that in his presentation, versus, say, industrials, for example. I mean, industrials, you have got structural drivers behind you. You are generating strong rental growth at the moment. You haven't got that in retail, but you have got a solid income profile. So it can certainly, fulfill the function. So we're a big fan of certainly retail parks across UK and in Europe, and in Germany in particular as well. We've, had a big investment programme there, and, we've deployed capital very well. Again, good solid incomes and proper structural reason for those retail assets to continue. When it comes to shopping centres, our view has been, and the client's view, is that we're looking for core, dominant, long-lasting experience offers. Our European Cities Fund, for example, one that's just been sort of referred to, really is open-ended, but actually we've got again, good liquidity mechanisms sort of built into there to ensure we are buying for the long term, to potentially look through cycles. And in retail, we recently purchased one of Intu is our partner. They're actually down in Xanadu, which is in Madrid. Terrific sort of plans that Intu as our manager there have got for developing out that particular space. So we think those sort of assets in growth markets like Madrid are going to do very, very well indeed. Convenience very good. The area where we start to find it quite difficult really is in larger, in particular, sort of secondary centres, clearly. And I think, that just sort of comes down to trying to underpin cash flows. Investors are looking for security of cash flow and trying to understand that cash flow moving forward. And in the secondary retail space in particular, it's far more difficult to do the underwrite. You've got to be specialist, you've got to be on it, and you've got to have the sort of people on the ground to be able to do that.
I just wanted to pick up with you, Michael, if I can briefly, just in terms of the secondary versus prime locations. You're active in some of the more secondary ones, maybe potentially in France, for example. What's your view on that, and also what's your view on that for the UK especially?
Well, it's fair to say we've very deliberately been selling out of secondary kit over the last sort of 4 years. So the portfolio is looking decidedly more prime than it has done for a long time. So in terms of type of, picking up that type of retail theme, the retail theme that I think is interesting is just looking at the type of penetration and influence of internet shopping across the different European countries. And I think that the UK is really leading that trend, and therefore I think it doesn't take too much to see where the threats are going to pan out in continental Europe. Our largest single asset that we are engaged on is anchored by retail, but that's a pretty unique, very prime product, and the key there is getting all the different uses on site type of working together, and that's something that we feel very comfortable to be involved with, but otherwise I'd be pretty cautious.
Okay, and just very quickly on the alternatives, in the US, very mature in terms of multifamily and those kinds of things, but also healthcare, REITs, there's a lot of activity in that market. Do you think the amount where Will highlighted that there was much more investment activity there, is that a sign of the market being quite hot for other assets, or do you think that's more sign of those particular sectors maturing?
I think it's both. I think there's an argument that people gravitate to alternative sectors because they're struggling to find value in the traditional food groups. There's an argument that these sectors will institutionalise, and therefore, if they institutionalise, capital flows into them, and you get, good cap rate and income returns. I mean, I think it works both ways. I think with some of it that's more operational, like hotels, like self-storage, potentially like student accommodation, I think some bigger institutional investors do underestimate the risks of running operational businesses. It is different. But I think with I sold a bunch of care homes to Morgan Stanley in 2007. Morgan Stanley's plan was to create a pan-European healthcare REIT. It's not happened, 10 years later, but I think actually in the next 10 years, I think it might happen. Standard Life, interestingly, announced a pan-European sort of PRS BTR fund last week. So I think Balfont's has got one of those, but nobody else has. So pan-European residential, I think, is quite interesting. I think obviously UK PRS, there's so much activity in that, it's almost ludicrous. I think the reason was that there was no sort of benchmark for UK resi. I mean, Grosvenor's been doing it for 450 years. But the world and his wife, and I was one of them, ploughed into that market on the basis it was a new market. There wasn't a IPD 30-year benchmark, so hey, anybody could do it. Every week you read about somebody getting into UK PRS. I really worry about that, I have to say. I think that if you're looking at sort of accidents waiting to happen in our industry, that'll be one of them. What else? Data centers don't really do those. I think they're interesting. I think there's room. There's absolutely room for it. But you've got to know what you're doing, I think.
Okay, good. I've got one quick question, which is for you, James, there, which is, interestingly, last year we did, as in 2016, I think we did 3 or 4 sessions purely on risk. Interestingly, this year we've done 4 sessions. We haven't done one on risk at all, but this year we've done 4 that are on technology, innovation, disruption into the market. So just interested to see how those things are coming. That picks up the parking thing possibly as well. Just in terms of the influence on real estate, whether that's in 2018, whether that's over the next sort of 5 years, are those kind of things that you're especially thinking about? Because obviously we've got different types of office use. We've got potentially in Tokyo, I think yesterday they announced that they were going to start doing driverless taxis, experiments with that in March 2018. How many of those things are you looking at, and how many of those do you genuinely think will influence our market? And anybody can pick that up as well.
I don't know which ones will influence more than others, but I'm pretty sure that technology is going to have an enormous influence. Not necessarily directly, could be indirectly, but a lot of it will be around really what it means to people. Ultimately, property is a form of shelter in one way or another, either for people to live in, or people to work in, or people to go and shop in, or whatever it is. And because people have got a lot more freedom than they used to, they drive differently, they go to work differently, all these things, it will have an enormous impact. I think that what we're probably seeing is that in a lot of areas of property, not just retail actually, there's just too much. And I think, what's the future of all of the kind of the big food groups and the long-term need for them, I think is a big question. I can kind of see why a lot of people are moving into residential. We're doing more of it than we used to, because ultimately I feel a bit comfortable about things that have beds in, because the people will need somewhere to be.
You can't have a virtual night's sleep.
I think we will definitely see, if not next year, sort of in terms, I don't think you'll see a valuation impact, and certainly not immediately. But I do think the increased prevalence of technology is going to be a major theme. I think we're already seeing it. And if you look at how people use real estate, to your point, in particular office, the blur between office, social, living is just, definitely there, and that is happening. And I think technology is a part of that, although behind the scenes, potentially at the moment, if Uber did a partnership to sort of deliver with tenants of particular buildings that they get points on Uber to order their taxis. That whole sort of prop tech theme runs at the moment potentially a bit more in the background, but I think is likely to come to the forefront. I think you've also got Facebook or other building a city, etc. So it is, I think, going to be probably the single biggest influence, not immediately, potentially, but over the next few years.
Okay, good. Michael, you wanted to quickly pick that up.
My view is that I think we're all, or generally most people, are underestimating the influence of technology in cars. It's an area of particular sort of interest, but if you I think that it's not a 2018 issue, but I think that the UK government is banning sale of petrol cars from 2040. This is going to be completely sorted miles before those days. I think we're coming to a big Betamax VHS type of question mark in terms of, are the cars going to be driven by James and Joss, and are they going to own them, and therefore are they going to be interested to be buying cars from BMW and Mercedes? Or are cars going to become just a utilitarian vehicle that is hired and you call it up, and it happens to be owned by Apple because they want to sell you the content while you're driving there, listening to whatever they're trying to sell you? That has the most enormous impact upon the number of cars around, because if we all own them, fun enough, it's not going to be too different from the number of cars that are around at the moment. Otherwise, on average, we're using our cars 4% of the time, and therefore you can probably get away with 10% of the cars that you would otherwise need if they become the utilitarian vehicle that some other organisation yet to exist owns. The impact upon car manufacturing is immense in terms of, does design really matter? Do we really care whether it's blue, black, whatever colour that car is? And what impact does it have on petrol stations where the investment return on retanking the tanks for petrol is 25 years? So those decisions are all being made now, and the impact upon residential, the impact upon retail, and new shopping centres being developed with 4,000 cars, spaces 3 floors below ground. What on earth's going to happen to that space? So I think that these things are going to become a lot more important quicker.
James?
No, I'm just thinking that an outlier risk around technology, interestingly, I think is then the government everywhere, yeah? Because I think that whilst technology is moving forward very fast and there's lots of really exciting stuff, governments are saying, well, on the one hand, it doesn't seem to be really driving any productivity gain at a country level, and oh yeah, I've got 25% of my workforce is now at risk. So I think there is a sort of an outlier risk that governments are going to say, I can't have that, and they're just going to start regulating everything to try and protect people.
Okay, good.
Yeah, just to pick on that, the social consequences of going driverless are immense. If you think of America, 35 million people, Americans, are employed driving cars or trucks. That could just disappear. The social consequences in this country in terms of who's going to be affected by those decisions, who's going to come off well out of technology, who's going to come off really badly out of technology, have a huge social issue that will challenge governments.
And I think at the moment what you're seeing with technology is the number of people who are coming out very well is much smaller. So the whole idea of the sharing economy is a nonsense because it's being shared amongst about 4 people. I think but technology is also, law firms, accounting firms, all these things. Blockchain and so on. These are huge things that are going to have a big impact on it.
Interesting. I think it's really interesting because the other dimension to this is where is that technology actually going to get pioneered? Because if you look at China, you've got 830 million active internet users in China. I think it's Didi, which is the Uber equivalent in China. They have more rides per day now than Uber has in the whole world. And so a lot of that technology is going to get pioneered based on what Chinese people want, not what Western Anglo-Saxon people want. So there is a complete dimension to this, is that we've been used to becoming Americanized in terms of the way in which our technology is designed and brought together. It may change quite significantly over the next 20, 30 years because the market out there for adoption of that kind of technology is much, much bigger, and the barriers to change there are much, much smaller if they can politically get their heads around how they work.
Okay. we've attempted to do a 2-day conference in an hour and a half, so that's and it does look from this as though it may be that innovation and technology will also be a theme in 2018. Just quickly, starting with you, Simon, so that everybody can take something away with them from this, is just in terms of investment, 2018, what are your favourites in terms of sectors, locations, where do you think people should invest? And we'll move down the panel. It can either be UK or Europe, whichever you fancy.
I think we will probably do more in Italy next year, and we'll do more in France. I think we'll continue to do some more stuff in the Netherlands. Our cost of capital's higher. We have to be looking at markets that are earlier in the cycles and where there's a bit of dislocation. We like the Dutch market. We like Southern Europe a bit more now than we used to, I think, and I think that's where you see us probably spend most of our time. There's no particular sector bias with us. We're completely idiosyncratic, almost agnostic when it comes to sectors. It's really just about price.
Okay, good, Michael.
I think, bearing in mind where we are in the cycle, whether we're certainly coming towards the tail end of it, we like debt in particular. I think it's given good risk-adjusted returns, it's hard to deploy, to be fair, to get to the returns that are needed, but we've got a good deployment programme, and I think from a risk-return perspective, that's a strong place to be at the moment. I think from an equity perspective, in the UK, actually, the sort of regional dominant centres, Birmingham, Manchester, and the like, are actually attractive from a yield perspective. And we like the look of that as well, to be honest.
Okay, good. Mark, you can
quite fortunate in that clients tell us where they're investing, and we do those deals for them. But if it were my money, I would do logistics, and probably either big sheds or last mile sheds in UK or Germany.
Okay, good, James.
I think for income strategy, for me, it's about where I think actually GDP will convert into rental growth, which is not happening everywhere. So I still quite like Sweden in that area. I think it's doing quite well. In terms of what I like, I'm doing more residential, which I mentioned, and actually more in terms of developing residential, and I like Madrid.
Okay, good.
Yeah, I think most of our money is core money, so we are really focusing on the major, deeper, liquid markets of Europe. If I look at what we discussed at investment committee yesterday, it was an office in the middle of Milan. I mean, we're paying, prices for these, but an office in the middle of Milan, a sale and leaseback that we've conjured up in Germany, another sale and leaseback, sort of a portfolio sale and leaseback in Italy, and then a multi-let, quite big building in Paris. All of these have themes that they're well located, they're fairly new buildings, they're near transport nodes, but you're paying yields of 4.5 for these at the moment. So, but that's what the core funds want. So I'd carry on doing that.
For our core plus type of value-added investors, I think we will be most successful next year in terms of Benelux. I think we'll do quite a lot of business in regional UK, and my suspicion is we will continue to struggle really badly trying to invest in France, where the delta between our bids and closing prices has averaged somewhere between 20 and 25% all year.